Ketan, can we start the webinar?
Yes, so we can start the webinar.
Yeah.
Hello. Ma'am, is there any problem with the network? I think sir got disconnected. Sir got disconnected and I think he's trying to rejoin. I think presentation is also gone. Yeah, the presentation is not coming.
Ask him to unmute, please. Oh. Hello.
Hello. Yes, sir. Now your screen
Yeah.
is clear. Yeah.
Okay. I'm sorry, everyone. I think we suddenly lost some connectivity, and then I had to like log in back and then get in.
Good morning, everyone, and I'm Arjun here, Arjun Patsarthi. Welcome to our webinar, and I'm very happy to have all of you here on a Saturday morning. This is to this webinar is just to given that INR bonds has been at the forefront of tracking the markets and giving out cutting edge reports and analysis on investors to help them in decision making. And we are doing a lot, much more right now on our platform. And then when we are starting to build models around what's happening in the bond market. So this what we aim to do going forward is to provide with put bonds and bond portfolios to those to investors, to wealth advisors, to wealth managers, product ideas to asset management companies, etc. Largely based on our models that we drive through the detailed analysis that we do on the bonds trading in the market, and that are bonds that are available in the market. Today's agenda would be we'll focus on the risk in the interest rate market at this point of time, current market environment, and given that the interest rates are so low and people are really searching for yields, right? And the question, and so how does one invest? And then we'll also take you through some very smart portfolios that our models have come out with. So let me just briefly take you through what we are through what our platform is going to give you going forward, and which will actually help. We aim to work with the whole ecosystem in that sense, with our kind of unique kind of platform that we're building to help people both solve all the problems that is related to investing in bonds at this current juncture, and the fact that the bond market is set to grow and is expected to grow exponentially going forward, largely because debt is the only thing that is driving the world at this point of time. Obviously, you have key risks and a lot of pitfalls ahead, but with a platform like ours, where we come out with very strong ratings for bonds, we hope to help navigate, especially um, the people who actually advise investors to take the right investment decisions, right? So let me just start off the presentation today. And once I finish the whole presentations, then we'll have a Q&A, and people can ask any questions through chat or by raising the hands, and you can ask your questions, right? Right. So let me just briefly take you through through the presentation, today's agenda, right? So we have what we call we have done a lot of homework over the last many years, in the sense that what are the main problems that investors are facing. Now, as you all know, the government bond market is extremely liquid, electronically traded. In fact, it's one of the best. It is, I would say, it is the best in the world in terms of electronically traded market. And the way they have gone about it, I think it's an amazing job they have done. So clearly, I think government bond is trading like equities, but unfortunately, it's largely institutional market. Whereas now the retail market, which is more corporate bonds, I'm not saying it's corporate bond is it's still very much institutional, but then there is more and more retail participation in the market. The market has not evolved at all. In fact, it's not moved. Given the size that the market has moved, just to give you a statistics, in the last 10 to 12 years, from being 1/3 of the government bond outstanding, the corporate bond market has actually gone to about 50% of the government bond outstanding. So its market is growing exponentially, but everything surrounding the market is not growing at all. And so we saw the five, and obviously, I mean, there is a huge amount of hue and cry on by policymakers on how to increase the depth of the corporate bond market, etc. But still, they've not been able to arrive at a solution. Right. So the five main problems that we have identified with extensive user interactions over the last many years has been lack of information, lack of price discovery, lack of issuer, lack of understanding of the issuer, and lack of liquidity, and even more important, the lack of ease of transaction. So it's never that it's just like equities. You just log in on an app and trade. A corporate bond is still a cumbersome process for anybody, and this so all this is hampering obviously liquidity in the market, and also hampering investors, more and more investors to come into the corporate bond market. And with all this now, with so many bonds listed, with so many bonds traded, and then etc. And with all this, there's given that there's so much of again. Yeah, with and with so much of different kinds of information given to investors or advisors, etc. There is a lot of confusion on what's the right investments to make, right? So people go about investing based on various different factors, and we have seen in the last many years that there's been last 3-4 years, especially in the last couple of years, there's been a huge amount of pain with defaults and lack of liquidity, with even mutual funds shutting down, etc. So all this has really hurt investor sentiments on the bond market. So what our INR bonds here helps you to do is to find the right bonds, and that's very clearly. All you just have to come to our platform, come to our market watch screen, and you can actually see the bonds that are being traded regularly. You can check our fair value, what is the right price. You can check all the bond information that you want, right from issuer report to the cash flow that what are the bonds listed, etc. Details of the bonds, and you can also check our proprietary credit spread score, which is actually choosing bonds. And then we also, based on the proprietary credit spread score and credit spreads and the fair values, we arrive at our algos come and help you choose a bond portfolio. Now, I'll show you some bond portfolios that we have picked out, chosen by our models. And so it will help different kinds of investors, and also help navigate the very difficult corporate bond market navigation, right? This is a very, very useful tool, especially for advisors who are advising the clients on portfolios, largely due to the fact that all the back end work is being done by INR bonds, and all you have to do is take an informed decision to help your clients achieve their asset allocation or the investment objective which you have been helping them with. We have a lot of plans with this going forward. Hopefully, the liquidity itself will take many shapes, and we will try to make liquidity much more seamless. So right now, the platform, right now the app that we are building will be something like this. Hopefully, the new app should be released in about 15-20 days. We are in advanced stages, and So like I said, the bonds will be smartly chosen by us, by us based on our models, model credit rating scores and credit spread scores. We don't say credit rating because that's the rating agency. And here I'll make a clear distinction. The rating agency provides credit rating. What we provide is the risk of spreads, right? And so the most important factor is always the risk of spreads in the corporate bond market, because that's the valuation. That's the single most factor for valuation of the bonds, unless the bond is trading at default levels, right? So with this, with our model, credit spreads per model itself, I think you should be able to avoid a lot of pitfalls that are seen in the defaulted bonds, especially how to avoid the defaulted bonds going forward, right? Then so this is how the home screen will look like to a large extent. You can search on the screen. You can see there are a lot of filters available. It will give you a whole host of information that you can see on the bonds, and even more important, it will allow you to uh, it's got a very smart search option that will actually can be customized for your own user profile, right? So the model, the app itself will have an AI that can actually help you in your bond searches. Now, and even so, to make it much more easy to transact, then or if you have chosen a bond or a bond portfolio, you just click on the buy or sell buttons available, and then it goes to where you can transact, right? So we're trying to make all this very seamless for everyone here. So we are trying to so this solves a problem across, which I mentioned, right, from liquidity, lack of information to the ease of transactions. And so as we go forward, I think you will be able to transact much more easily, and all the transaction will either be through will definitely be through one of the clearing houses, so which to avoid counterparty risk, or it could even
Yeah, participant, there is an interconnectivity issue. So we are trying to reconnect and we will be back shortly. Give us some couple of minutes.
Hello. Hello.
Hello. Yes, sir.
Yeah, can you hear me? I'm sorry,
Yeah.
everyone. We're having some connectivity issues and just getting cut off. Ketan, now next time it happens, just share the portfolio on your presentation on your screen so that it doesn't get affected.
Yeah, we'll do that.
Right. So, like I was saying, just one. Yeah. So, like I was saying, we are. So the platform can help you in a whole host of ways, right from selecting the bonds or bond portfolios the to execution of the portfolios or the bonds, right? So coming down to today's agenda, what are we seeing? Basically, the agenda today will be key risks in the current environment, how to negotiate low returns and fixed income investment ideas driven by our knowledge. So just in the current environment, clearly, I mean, you have what are the main risks I see is that you have ultra low policy rates. So clearly, I think now if you look at if you look at what the Fed has indicated is that I don't think they will change the rates for 2 years at least. The policy stance, they continue to build the books. And I don't think they'll ever be able to normalize, right? Now, that's why one of the reasons why the dollar is weakening sharply is because of the Fed policy. And we don't know what is going to play out because what we are seeing is we are seeing a very strange situation where you have bond yields are down, corporate bond yields are down, junk bond yields are down. You have gold prices at highs, you have silver rising, and you have equities rising, right? So everything is like doing so well, now, but there are also so many. The markets are getting so much used to this ultra low rates and liquidity. They might take on extra risks, and then suddenly again it will blow out, and then the central banks will not have any kind of ammunition left because in 2008 they did the same thing they're doing now. In 2020 they have tripled what they did in 2008, and now in this situation they are actually exhausting all the tools because the markets are going to become immune to any kind of liquidity going forward, right? So what's going to happen? What are the pitfalls of this? We don't know, right? So given the domestic market now, what will the RBI do? RBI obviously cannot normalize conditions. They have to, despite the fact that inflation is way above their target, and also it doesn't look very rosy for inflation at this point of time. There are supply constraints. There are labor shortages. There is so much of subsidies given to the rural economy. So you have government fiscal deficit ballooning out, so much of issues, right? And you still don't have any problem. I mean, but with all this, RBI just cannot afford to relax on their accommodation, largely because there's so many issues that is cropping up at this point of time, right? So excessive borrowing government, and so the government borrowing is like shot up, and this is not. And what obviously as the outstanding debt levels increase, they'll have to borrow more to pay back to repay the debt, and this is never going to have an end. And they obviously in a weak economy, they cannot raise taxes. So what they do? They'll have to continue to borrow. And how much more can the RBI finance the deficit? So will it become a never-ending scenario where the government borrows and RBI pumps in the money? So what happens to that whole thing, right? So we don't know what's going to happen going forward, but it's but what it obviously does is makes it very difficult for bond market investors, right? And then you have investors. Then you have credit risk. sustained economic weakness. So RBI in its latest financial stability report has indicated that NPAs are going to rise maybe by 4 to 7 percentage points. And that would mean a huge amount of capital infusion by banks, by the lenders. It would also mean that weak lenders could have problems. What will the RBI do to solve that problems in this economy, right? And what about the current market conditions? Can credit spreads stay where they are? We are already seeing very strained markets, despite the fact that spreads have come down. And so, what kind of portfolios can you build? And then you have search for yields. So investors now the returns on the market is pretty poor. As in, given all this, what will the investors do in terms of trying to get that, trying to improve returns in the portfolios, right? So you have just some curves here. You have the government bond yield curve, which has compressed. And those of you who attended our last webinar, we had it a couple of months ago. We had mentioned that one of the bond market plays was a need for compression, which has happened substantially. So the 5/10 has steepened, and the 10/20, 10/40 or 30 has actually flattened, with the longer end yields coming off sharply. But how much further can it go? So you also have SDL spreads coming off. You have corporate bond yields spreads coming off. You also have corporate bond yield spreads coming off for the AAA rated issuers. This has come off very sharply, largely because the market's liquidity improved. Some of the better perceived better borrowers are able to access finance, and the government also come out with some kind of solution for providing liquidity to the corporate bond to the issuer lenders, and so that has led to some kind of a spread coming off. But having said that, there are a lot of bonds that spreads are not really moved at all, especially at the lower end of the curve. Right, SPL spreads have come down. There is still a move towards buying into state government bonds, largely because they offer some kind of a spread in a market where there is nothing available, and especially this is more specific to regulatory buyers like insurance companies and provident funds, where they have to look to enhance their returns. Right. So just on a global side, U.S. bond yields are at almost 0.5%, with coming down to record lows. And what do you get here? Nothing at this point of time. And so with all this, what do you do in the market? Right? So you have the dollar moving, right? So as I mentioned about the dollar weakening, the dollar is weakening substantially, with the dollar index falling. And this has really hurt them. This is really driving up price.
Audio is not clear.
Hello. And this is really driving up prices of gold. Right. So how to negotiate low returns? Can you build how to build smart portfolios? Okay. So in current context, if you really look at it, your fixed deposit or at the short end of the curve, if you're buying bonds, etc. Post tax, you're getting just about a 1-2%. I mean, you'd rather not get anything, right? In India, and you have inflation, headline inflation running at 6%. So you're getting nothing at 1-2%, and it's a huge problem for savers or investors looking to invest. What do you do to invest? So you have tax-free bonds that are trading at 4.4 to 4.5, 4.5% levels, and this is across. This is even for 10-year, 15-year bonds, and these are clearly. I mean, they are, given that it's not as if that rate risks are not gone away. They are still very much there given. So given the risks that I mentioned earlier. Now, so but then what do you do when you have such low rates, right? So you find whatever is available that can give you some kind of a shield against such ultra low rates. But having said that, do you take high risk and high risk in terms of going on to higher yields? Very rare. Really, unless you can understand the kind of high yield, or unless you're a professional investor who can actually take in such kind of risk through, say, through such kind of funds where people invest knowingly in such risky funds, it's very difficult for an individual investor or even advisors to advise on high yield bonds because they don't know what's going to happen. And if anything happens, then very difficult for individuals to actually, or even institutions to actually go and get some small money out of them, as we've seen now with all these defaulted bonds, right? No one's got anything yet, and doesn't look like anyone's going to get anything soon. So the first thing always is to protect capital, but then at the same time try to get high returns. And so this is where actually smart bond portfolios can come. I'll show you some of the ones that we have built across. And also, we can give you blended, also you can look at blended portfolios for strategic returns. And yeah, so one investment theme that we are coming out with is introduce bonds to gold, right? So gold is something that is, as I mentioned, is going up and up. It does come with risk because it can go down and stay down for a long period of time. So how do you manage that risk in gold, but still want to participate in the gold movement upwards, stay at the same time being liquid and getting some kind of a fixed return on the portfolio, right? Yeah, so coming down to some fixed income investment ideas. This is how we are built. This is how our models are throwing up portfolios. For example, if a treasury has cash, excess cash, and they have to invest, right? Now given that the rates are ultra low at this point of time, but if they want to take some kind of a higher get some kind of a higher return on the portfolio, they can look at a portfolio which is very low on our credit spread score, which would mean that whereas and even as the spreads are very reasonable, the duration is also very reasonable. So you have a duration of say just about 1.5 years, and you have a low spread score. That means the risk is low on the bonds, and largely if you've taken the bonds that we have actually selected here, what you see is one is some of the bonds are obviously government-owned bonds. The other bonds that are there have very high capital adequacy ratios or very high or very good access to liquidity. So in that sense, a corporate treasury who's got some kind of excess cash can look at such kind of portfolios, right? Then you have same for the treasury itself, but if they want to go slightly up the duration, got longer term money, or they want to get in some higher kind of yields and higher kind of spreads, then they can look at the same bonds but with different kind of a duration profile at about 3 years. The average spreads are in the range of 200 plus basis points. Some of them are 200 plus, and some of them are between 87 to 115. So across different kinds of spreads on the spread curve. So you have, and again, the bonds are the same in the sense in terms of risk. So you have a portfolio which is improving your returns on a slightly better basis, right? And this is something which is very attractive for across the investor segment, and maybe more for individuals who are um, looking to earn more than what they could have earned in deposits or anything else. Some bonds that are pretty much pretty much in terms of reasonable risk, um, uh, good capital adequacy, right? Or with access to capital like PNB housing. Then you have Embassy, which is a 2-year bond. While you still have issues on how the commercial lending space is, commercial real estate is going to behave, especially rentals. They have come out with very strong liquidity and collection statements, and for 2 years, I think they can still hold on. Then you have Tata Capital, which is again a Tata company. So in that sense, what our credit spread score model has brought out is a reasonably low duration, which is about 2 years, with a spread of 420 basis points. I think the spread is pretty good for such kind of a portfolio. And the gold loan companies are doing extremely well. They have strong capital adequacy, and they have um, they are actually growing the books. I think one of the very few lenders, apart from, I would say, some kind of a very niche microfinance players, who are actually got some kind of a visibility in both in terms of NPAs, because gold is still rising, still very highly liquid, and you still have the margins are pretty good, and also on the very niche microfinance, there also I think the lending is pretty stable. We did see Bandhan Bank coming out with some very decent numbers and statements, largely on the microfinance portfolios, right? Uh, so yeah, so one of the main, I think one of the best investments, one of the best funds to be floated in the recent past is Bharat Bond ETF. It provides you it provides you a list of very safe government-owned banks, government-owned companies. As in, the individual companies itself may not be very strong, but then government backing is very heavy in that. And it's an ETF, right? So you just buy into the bond, you have indexation benefits available, and you can use this ETF for various purposes, like we'll show you going forward, right? The spreads have come off very sharply. So the risk you're taking is interest rate risk. So you'll have to take a risk on. You'll have to take a call on whether interest rates will rise or fall going forward. So basically, what you're taking on is a government bond risk with some spreads available, right, on this ETF. Right? We have seen extremely good corrections in this. I think the liquidity is also fairly good, and we should see more of these kinds of structures coming through because it's the easiest way for investors. Globally itself, ETF market is growing exponentially. In fact, in the last 1 year, BlackRock is only company that has actually their bond ETFs are done so well, and the Fed is also buying through their bond ETFs. So they've really taken off globally, and it's and we what we hope to do is to build through our portfolios, build more and more of ETF structures, and let's to see if we can actually provide you that kind of ETF kind of benefits going forward. Right. So again, perpetual bonds, you have the bigger banks that are too big to fail. Um, uh, so uh, um, so that's one. But having said that, perpetual bonds are a separate category of bonds. You have to take a. I would say this is a very investor-driven, risk-driven segment. It's very difficult for anyone to advise whether the bank's bonds will be called or not, because there is absolutely no way you can determine the pricing. And also you have, how do you factor in a quasi equity risk premium on these bonds, right? But having said that, these are the better quality, top quality perpetual bonds in terms of credit risk. And these are the high yield bonds in terms of credit risk. The yields are pretty high here, as you can see. But then uh, this could also mean that would anyone have a yes bank kind of a situation going forward? Very difficult to say, but it's obviously at the investor's own risk. And a spread score also indicates that they're all very high risk bonds. Uh, and then you have the very high yield ones like the Shriram Transports and the UP Power and Vedanta. Again, our spread scores are not at all favorable to these bonds. But having said that, you have high yield and you take higher risks. And if you can actually uh, come at a conclusion on whether these companies will continue to um, service the bonds, then I think these could be some kind of portfolios that you can look at. Now, you can look at blended portfolios. For example, if you can have an high yield portfolio, which is maybe about 20% of the weight of the portfolio and 80% into government bonds. So, which can take your blended returns higher. So, for example, if 10-year buy a 10-year constant maturity ETF at around 575 semi-annual, and then you buy this at around weighted average yield of around 12%. So you can 70-30%, and then even if even if there is one of the bonds default, your capital is protected to some extent, to a very large extent, I think, because the others will give you that kind of a coupon flows to actually cushion you. There are, you can look at many blended portfolios. We are not covering everything here, but going forward, if people want suggestions, you can always come to us, and we can throw our models, blended portfolios, which you may come to us if your if it can be done to your requirements, right? But these are just some of the suggestions that we are given. But having said that, we have taken these are all bonds that are being traded frequently in the market, right? And unfortunately,
So you are
hello.
connected. You are connected again.
Yeah. It's okay now.
Yeah, it's okay.
Okay, fine. Where did I stop off, Ketan? Hello.
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 So
Yeah.
you stopped that you are discussing about this. These bonds are most frequently traded in the market.
Yeah. Correct. Okay, fine. Yeah. So they're most frequently traded, and they have. We have selected the bonds that have been traded into factors, right? Um, but going forward, we hope to provide more on illiquid bonds as well, depending on the kind of how the market also how it is, how it evolves going forward and the kind of demand that is building up. But there would be more and more demand coming in, I would guess, and we should start to cover liquid bonds as well, right? So with this now. This is we also built an SDL portfolio, the strongest SDLs in terms of financials, and largely because we have taken the fiscal deficits and the of these SDLs and how they've grown, and the kind of some other parameters, and we have thrown up some kind of an SDL. We've thrown up these four SDLs. we have thrown these 4 SDLs, right? Um, 4 states, and you can invest in bonds across different maturities in these states to bring down your duration risk as well, and still get some kind of a improved return on your portfolio with a lower duration, with a reasonable spread over the government bond. It's around 58 basis points, right? So this can, I mean, this can take in various kind of formations as well. So as we launch the platform, you should be able to just enter your detail. You should be able to enter your requirements, the bonds, your required maturity, and your required risk profile, and the platform will automatically throw up a bond portfolio that you can actually execute. Right. Then this is something which is very unique in terms of our product, our portfolio recommendation. I would say suggestion rather than recommendation, or just something which anybody can look at. Very liquid portfolio. So you buy 5-year Bharat bond when it lists at say SFI 75, and then you buy a gold ETF, right? So so this actually basically this is this is for a fixed income portfolio. So you have an asset allocation of X amount into say fixed income. So within that asset allocation, you can divide that portfolio between Bharat bond ETF and gold, right? So you can do it in a weight of say 70-30, which is gold 70 and the ETF 30%, or gold 60% in ETF 40%. And then you arrive at various permutation combinations. Assuming in 3 years' time, gold prices move up by 25% or 50%, what would be your blended return on an annualized basis? So we see it coming out well over double digits, and these provide indexation benefits as well. So this, I think, is a very strong portfolio for some investors looking to improve their risk, keep very liquidity extremely high, as well as, but also take a little bit of risk, because you also have scenarios where gold prices come down by 25% to 50%. But when we see that as well, we don't see too much of loss on the portfolios, right? So that if you're willing to take a bit of loss in the event that gold prices come down, then you can actually look to execute such kind of portfolios, right? So we have the permutation combinations in the slide here you have given. Yeah, this is something given that the dollar is on an extended weakening path, and it's going to continue to weaken. Gold prices are at record highs. Some people would balk at gold. But having said that, and frankly, to let you know that even I have been a very gold skeptic for a long period of time. But when in April, I think when people who have come to us started with our webinars, which we started then, would have heard me talk a lot about continued dollar weakness, which I've always said it will happen because of the way the Fed is throwing money, and they have no ways to stop throwing money, and that's debasing the currency very sharply. And now with all this China issues going on, it's going to get worse and worse. Plus the pandemic is still very much around. So all this is not going to help at all the dollar. And with this, gold can continue to go for a rally going forward. So if that's the kind of view you have, then you can actually build a fixed income portfolio based on Bharat bonds and gold. Now, you can even replace Bharat bonds with one of the portfolios that we have given you above on the credit side, and that will improve your risk return profile substantially, right? So if you take a 3-year high yield corporate bond, which is a mix of pretty much safe bonds, then you are increasing your yield by about 4% annualized, right? So in that sense, and also reducing your risk, even if prices drop, your risk of capital is reduced substantially. So with all this, I think you can do a lot of mix and matches. So let me end with this. I think I'm sorry about any kind of the delays that we have had because of connectivity. and it's solely at my end actually. I think I've had some internet outages here at this point of here, and but having said that, I mean, hopefully I think everything went off well. And if you need to have any kind of additional support, if you have not heard anything, always please come back to me. Ketan will let you know, and we can always fix up a call, and I can take you through anything you want. So with this, I'll have any questions you have. You can either type in your questions to the chat, or you can raise your hands. Ketan, if anybody raises hands, just unmute, let them in.
Sure, sir.
Right. Okay. Somebody is asking now. Yes. Let me just go to this question. Dharmendra has asked, what is CSS? CSS is a proprietary credit spread score, which is which we calculate on using various metrics. We use interest rate risk, we use credit risk, we use market risk, and we use liquidity risk, right? So so that means we cover all aspects. We cover the rates, we cover curves, we cover macro credit markets, we cover micro issuer to financials and sector profiles, and we cover the liquidity part of it. So we've taken all these risks into consideration, feed in the moments, and then we come out with the risk score. And so basically it tells you whether the spreads are whether the spreads can move up or down. What is the potential for the spreads to what is the potential for the spreads to spike or to fall, etc. Right? So it will give. You can use this as a very strong indicator, which is obviously. So that's why we never say the portfolio is a AAA portfolio or a AA portfolio, because it doesn't make any sense to us. It doesn't. It covers only one part of a very small part of the issuer risk. So we have a lot more other parts that we feed in, and so in that sense, it throws out a spread score, right? And our most interest is always in the spread, because that's what we call it. But for that's only one way where corporate bonds move on is valuations, right? Okay, now Sashidhar K is asking us, what is your view on interest rates? I think interest rates will stay down. Whatever happens, RBI will have to keep rates down. There's no question about it. At the short end, it's 4% repo and 3/4, which is reverse repo. And there's a huge amount of liquidity that will continue to stay. RBI will pump in more and more liquidity. I see them buying government bonds through OMOs, right? And when they saw that some kind of movements upwards in the 10-year, they came out with Operation Twist, right? Buying long bonds and selling short. So they are very keen to hold deals from going up. So the intention is very clear. So at this point of time, RBI is the main driver of interest rates. And as long as they are there in the market to keep rates down, it will stay down for a period of time. All right. On your okay, one question here is, what's your view on rate cut? What are you expecting? Now, I think I don't know whether they'll cut rates or not, but I don't think it really matters at this point of time. It's like saying rates are at the Fed fund rates are at 0 to 0.25%. What will happen if they cut to minus 0.1%? I mean, for Fed, I mean, going negative is something completely different, new, but they might just still do that. But what's going to happen to the market? So you had Eurozone yields at negative rates for a long period of time. What do you do with that, right? So I don't think rate cuts are really going to matter at all. As I said, rates are going to stay down for a long period of time, and whether they cut or not, it's not really going to affect any kind of any segment of the market. To some extent, if it does happen, then you can still see the 10-year actually come off, because it's been very, very steady at around the 580 kind of levels, right? Okay, so you have Rahul Agarwal here. How would buying bond on CBI differ from buying the bond on the exchange platform? Right. So yeah, see, the exchange platform is a transaction platform, and so buying the bond on CBI means you're buying it with a very strong backing of the platform research, right? So if you, like I mentioned when I showed you, you click on the bond you like, see the SPY value, see the credit spread score, see the spread, see the bond information, and then you click on the bond or you click on portfolio of bonds, and it'll take you to transaction platform, and the platform could well be the exchange. It really wherever there's liquidity of the bonds, it could happen. So it could happen through the exchange as well. So basically, the idea is to try and give you the most seamless kind of transaction platform available, right? If it doesn't happen through the exchange, then it would happen through the platform where you would transact through a counterparty through the clearinghouse, right? So that's the difference. And we don't see the exchange as we are not different from the exchange in terms of transactions. We will always, as far as possible, use the best transaction mode. And if the exchange is the best transaction mode, it will always be the exchange, right? So now we have Bharani again asking, how long will this liquidity driven rally go? A good question. Okay, the question is, the liquidity is going to stay, right? It's going to stay for this year, it's going to stay for next year, it's going to stay for the next 5 years, it's going to stay for the next 10 years. I don't see it going off at all globally. The Fed cannot afford to reduce liquidity to the market, so it becomes a Japan-like scenario. So I would suspect that the world will become a Japan, right? So you can then equate it to what happened to Japan 30 years back. Rates have been zero, and they have been pumping in and pumping in and pumping in money. And you'll have to see what will be the effect of that Japan effect on the market, right? So what happened to Japanese assets? Property prices stagnated for about almost 30 years. Equity stagnated. Hello. Again, I lost you. Sorry.
Yeah.
Okay. So at this point of
Hello. So you can
hello.
continue, sir. Yeah.
Yeah. 1 second. I'm just going to the chats. Okay. So the last question I was is from Varun.
So you were answering Bernie's questions. He was like, you were talking about Japanese assets prices.
Yeah. No, the next question was. I finished that.
Yeah, it's from Varun Narang. He's asking, how long do we expect real returns to stay negative?
Yes, correct. Real returns, I think you should expect it for a long period of time. And with the long period of time, as in what will be the effects going forward, I think it's going to be very difficult to predict what will be the effect of real negative interest rates. See, the idea is if you have negative interest rates, that means it encourages investments, and then investments encourages consumption, and then largely because it's an inflation theory, right? So you make more profits, etc. But then we have had very close to um, uh, we're trying to keep negative interest rates negative. It's uh, uh, but has it helped investments in India? It's not much because there's been there are many more factors that have come into play, especially lack of demand, right? Hello.
Hello. You are audible, sir.
Yeah. Okay, I'm audible.
Yeah, you are audible, sir.
Okay, fine. Yeah. So it's like I said, it's very difficult to say, and hence you could have um, you could have it has really depends on the investment sentiment. If it can pick up, then it can pick up substantially. Hopefully, maybe it will pick up over a period of time in a couple of years or so, if things start to stabilize. But if you really ask me when, it's very difficult to say. Right. Um, Let me just conclude by saying, like I said, I mean, rates are going to stay low, liquidity is going to stay high, but the risk is going to stay higher. And so there are no easy choices, right? And so you have to take smart choices. And if you can get the smart choices made, I think you're much better off. And I always suggest to stay liquid, right? Stay most in most liquid assets always, till uncertainty passes, even if you think illiquid assets are very attractive, unless you're able to unless you're a professional investor who can actually get that kind of risk funds and take that extra kind of a risk, maybe through an ARC, asset reconstruction company, etc. But that, I mean, they go in with their eyes open, but they will go in with a lot of other uh, to other other factors as well that can actually help them get that kind of returns they are aiming for. Right. So, do I see any more questions? One sec. Um, okay. Fine. Yeah, welcome, Barun. And then you have Sashidhar asking your views on perpetual bond of PSB. Yeah. Okay. On terms of credit risk, PSBs, I think they will be provided capital by the government. But then the government has come and said, apart from 5 banks, we don't want more. And so those who have been merged, the others will be sold off. So what happens to the perpetual bonds of the PSBs that are sold off, right? But and those of you who have been attending my webinars, I've always been very cautious on peer perpetuals, largely because there is absolutely no way we can tell you that I can tell you the right price nor valuations, and that's largely because there is no way I can factor in why this particular issuer will call the bonds. And the biggest risk you see is when capital adequacy ratio comes down, largely because of rising bad loans, which the RBI is saying will rise and looks like it's going to rise. Then if and at that point of time, if the ratio is very low and and the perpetual bonds comes for yield to call for calling, it's best not to call the bonds, because you can run it as the bond and then it stays as capital. And then so in that sense it becomes a perpetual and the pricing goes all over the place, right? Nobody wants to hold a bond that is 99 years, especially for a weaker credit, right? So that's the problem. Very difficult to advise on perpetual bonds or PSBs. As far as I said, I mean, the big PSBs, fine, the government is okay, providing them capital. But the smaller ones who are not merged, what will the government sell off and who will buy them? And what will the risk that will happen to them? We don't know. And also on the bonds itself, very difficult to price the bonds. So the risk on perpetual bonds, I would say, is about 3-4 times higher than the risk on a regular bond. Then you have Rahul. What's your view on moratorium getting lifted and its impact on yield? Yeah, so the moratorium, I think, will get lifted going into September. And that's hopefully that the lockdowns end in August. If not, then difficult to say. But having said that, I think once the moratorium is lifted, then you are going to see a lot of defaults happening, especially at the small business side, then medium and small scale, medium scale, which are supporting other businesses, because we are seeing a very strong fall in demand, especially and given the first quarter results, we have seen it's not only about production problems, it's also about demand related problems, and that's going to continue, and especially in sectors like infrastructure, in terms of real estate, in terms of auto, right? So if this is going to continue, then and obviously most of the small businesses have closed, um, and how will they repay the loans, etc. So it's very difficult. And also retail credit borrowers profiles are weakening very sharply. So you have job losses, you have pay cuts, you have maybe no prospects for no jobs. Then with all this, I think there is going to be a problem in terms of unsecured loans as well to the retail sector. And so with all this, I think you are going to see uh, moratorium, provisions rise, right? Now, what will be the impact on yields and spreads? Like I said, I think the weaker winds will definitely, spreads will rise as the market factors in more stress. Some of them have already factored in higher stress, some of the bonds, and the more, what is it called? The ones that have access to adequate capital adequacy at this point of time, and strong ownership, can actually see spreads stay lower, largely because of the fact that markets will continue to give them money for given the liquidity they have, right? Um, right. So you have Arnindam Bhattacharya. Okay, what's your view on AAA bonds and the spread scenario going forward with AA and below? Right. Okay, at the outset, I think I would rather term bonds in terms of a credit spread score, what we are putting out, rather than AAA, AA, because these are very small, general issuer specific credit risk that the rating agencies put out. They're not putting out anything further, right? So, but having said that, I will answer your questions. I think the AAA to AA and below spreads will stay elevated and could even rise, with the AAA staying at low spreads, and the AA and below going to higher spreads, right? Especially in the short term. We don't see how once the moratorium is lifted, etc. We'll have to see how the whole thing plays out. But then, and it's not going to look rosy. In the short term, you are going to see the spreads steepen in that sense. And if you are thinking of seeing opportunities of lower rated bonds spreads coming off, you might have to then look very, very closely at the issuer risk, right? So that's my view on that. AAA to AA spreads, right? So Bharani, about your model portfolio, can we buy individual bonds or the basket? You can buy individual bonds or you can buy the baskets. We provide both because the bonds can be because the portfolios are based on the individual bonds that are given on the market watch screen, right? So you can buy anything. So you have the option of buying individual bonds or the basket. Right. Any more questions? I don't see any more questions. Right. Okay. Then thanks everyone for attending the webinar, and those of you who would like to know more about our bond platforms and model portfolios and smart portfolio ideas, please get in touch with Ketan, and we can take this further, right? And like I said, I mean, we are here to help everyone across the ecosystem. So whether you are an advisor, wealth advisor, banker, or individual investor, or an asset management company who is looking to give portfolios to their clients, then we are always here to work with you on our cutting edge platforms. Yeah. Thank you very much. Okay, Ketan, we can close the call.
Yeah, we can.